Good afternoon. This is Brian Shannon from AlphaTrends.net, and today is Friday, the 14th of December, 2012. We had a little bit of a pullback here in the market today. It got down very close to that 50-day moving average, and it was actually in a blog post last night that I had mentioned that it wouldn't be a surprise to see the market come down to the 50-day moving average, which was at about 141.85 in that post. And you can see here, it wouldn't be a surprise here to see it come down in the next day or two. One thing I did want to point out that a reader who emailed me named Randy was aware enough to notice, which is on this 30-minute time frame, I had the 5-day moving average in the incorrect place. So that was an error that I had made. It didn't change anything as far as the analysis of the market goes, though, because we did get down to the 50-day moving average, and the NASDAQ also, the 5-day moving average was in the wrong spot there. But what we saw in the NASDAQ is we got down to the low end of that little band of this little range that we've been in, which has been defined by about 64.40 rather on the downside to 66.40 on the upside. Let's take a look at the numbers here, because for the week we did see negativity for the S&P 500 and the NASDAQ. The Russell 2000 was up slightly, as were the semiconductors, and financials are still kind of holding their own there. The biggest area of strength, I guess, was oil, and the worst was the U.S. dollar. So let's take a look at some of these trends here. And again, the 50-day moving average, we've got this market, the 50-day moving average is kind of starting to flatten out. We've got a rising 10-day moving average, a rising 20-day, and that 20-day is about to come up through the 50-day. So I do expect that we will stabilize in here. However, we don't have the evidence of that yet. So what we have to do is we have to be cautious in here until we see that we have in fact found some support in this area. There's no saying that we will find support, but we have short-term lower highs and lower lows, and that gives us reason to be cautious. You never know if a pullback is the end of a move or if it's just a normal pullback. We only know that in hindsight. So what we want to do is we want to keep an eye on the important areas where support tends to be found, like a 50-day moving average, and see if the market does in fact find support in there, which for the S&P 500 it is not. And again, we were down on the week, we're now down on the month too, and we're down pretty good on the month in the NASDAQ, and of course a lot of that has to do with the continued selling in Apple. We'll talk about Apple here shortly, but let's take a look at the SPY again. What we want to see next week, I think, is if we see further weakness, the worst I would want to see is maybe about 140.5. If we get below these lows in here, 140.5 or so, then we've broken this pattern of higher highs and higher lows. We're still in the pullback mode that we could, as long as we stay above that 140.5, we will have a higher low, although the rate of ascent may be slowing. So I think that's going to be a key level. What I had mentioned as far as if the market was able to pull back and then get going once again, then I think we'll be seeing it up near about 146 or so. And it is typically a seasonally bullish time of year. So far, again, for the month, the S&P 500 is down and the NASDAQ is down. So not necessarily holding true this year, but we've still got a bit of time left in 2013, and obviously the month of December. The NASDAQ, we had, in that blog post yesterday, I said that basically $64.30 was about as low as I would really be comfortable with this market getting down to. We got down to 64.47. If we were to kind of maybe flush out in here maybe a little bit, that wouldn't be a horrible thing. That is, kind of take these lows out, flush them a little bit, and then rally up. But we do have a declining 5-day moving average. It's going to be an obstacle likely if we do get back up there. And you can see that's been a real level of, first a little bit of resistance, this little band over in here, and then some support, turned back to resistance, support, and that was broken this week, and we got down to the low end of the range again. So with a declining 50-day moving average, we were looking for the potential of a break of this inverted head and shoulders pattern, and the resistance being at 66 to $66.40. That's where we've seen the selling just near term in here, and this is basically, we can view it a little bit more clearly on this 130-minute time frame. But what we had been talking about was this inverted head and shoulders pattern and how it was setting up for a potential break of the neckline, which would have bullish implications. It never broke above that neckline. In fact, now we're down at the low end of this range, it's reason to think that we have to be very careful in here once again, and it's really going to need some time to heal and recover. Otherwise, this NASDAQ could be looking like it could be headed down towards, in the weekly time frame, that we could be heading down and maybe creating a bigger shoulder for a head and shoulders pattern, which is similar to, of course, what we've been talking about in Apple. That Apple had this left shoulder, a head, and then this right shoulder, which formed very quickly. We were talking about, again, 2 weeks ago, if you recall, even back to over here, how good the 5-day moving average was, that the market had gapped above it, and then the pattern of higher highs and higher lows, and that got consecutively tighter. I've kind of warned about it breaking below 573 over here would be reason to move to the sidelines. It broke below it, obviously, and we've had lower highs and lower lows with a declining 5-day moving average. I mean, you can get some good bounces in Apple, there's no doubt about it, but the fact is it's in a downtrend. A lot of people don't want to accept that, it seems. We did take out these lows by a few pennies from last month. A lot of times you get a real short-term little low and then a bounce higher, but there, the Apple chart on the weekly time frame is somewhat disturbing here, that you have the potential for this head and shoulders pattern, which we could see it down, maybe not the real height of this pattern, but there's not a lot of volume that traded in this level. In fact, we could take a look at that. We're looking at real tick charts, and what I'm going to do here is add the volume by price in there. So what this does is this shows where the volume occurred, and what we'll do is we'll drill this down to instead the last 80 weeks, so we can kind of get a handle for it. And you can see now that by changing the amount of time, we've had all this level up here near 600 where we've seen bigger volume occur. There's a lot of distribution up there. Price has memory. That is, if it got back up to there, there'd be a lot of supply waiting. Well, now when we look at support, we can see that this has been an area of support in here recently, but look at how little volume traded. And let's just kind of change the scaling a little bit further. Look how little volume traded in below 5, in between basically about 420 and $510 a share. Very little volume at all. So it seems as though we could hit a little bit of an air pocket, and it could really get panicky in there for Apple. Now, I'm not going to say that that's what's going to happen, but I will say that the path of least resistance is lower. We've got a declining 10, 20, 50-day moving average. We've got the 200-day moving average kind of flattened out, and the market, the stock is in bad shape. The fact is, though, it hasn't hurt the NASDAQ as badly as it would seem to, but we have the potential of the NASDAQ following that pattern in Apple, and certainly if Apple was to have a bigger breakdown and head towards that 420 level, well, then it would certainly hurt this NASDAQ and at least bring us down towards that $60 level, I think. So a lot of reasons to just continue to be cautious in here, with a lot of mixed messages on different time frames. We're looking for the potential of support in here, but the pattern is lower highs and lower lows. Now we'll get bounces, of course, but now we're back below a declining 5-day moving average. It's going to make it more difficult. Russell 2000, we saw this market break past that $83 level, and we were talking about the strength of the Russell, over the last couple of weeks, and the inverted head and shoulders pattern. Well, obviously that strength is still there a little bit, as we were relatively stronger with a 0.34% increase, but perhaps we head down in the Russell 2000 down towards about 81.5. We've got the 20 and the 50-day moving average in that area. It's also a prior important level that we need to take note of. So really about 81 to 81.5 is probably the more accurate area that we would expect to become potential support. So we've got, though, on the 10-minute time frame, we've got lower highs and we've got lower lows. So since the Fed, since Bernanke, started talking, and let's take a look at the SPY on that. On the SPY, that was 3 days ago. We had first no change to policy, and he began speaking right about here, and we've seen the market sell off since then, obviously. And anyways, back to the Russell 2000, perhaps we are headed down towards at least the 81.5 level. We've got lower highs and lower lows, and we want to see whether or not this level does in fact hold as support, or if this is going to be from a failed break higher comes a fast move lower. There's a lot of reasons to be looking at this market with a skeptical eye. The again, this analysis I'm asked every time, what trading software do I use? What charts are these? This is Realtick, realtick.com. You can go to their site and get a trial. They're supported by many different brokers, different brokerage firms that is out there. They have a list on their site, so check that out. The semiconductors have been a little bit stronger recently, as we've noted. And in fact, they were up for the week about 3.37%. This market surprisingly to me took out the 32.50 level. We had some prior resistance. This had been a band of resistance at $32.30 to $32.50. Now this market has recovered nicely up through there. We're right around the 200-day moving average, and if this market holds, if the semiconductors can hold about 32.30, perhaps we've got a little bit of continued strength in here. They have had a big run. They've been up a little bit more than 10%. So a little further correction though wouldn't come as a surprise. Ideally, though, we'd like to see about $32.30 to hold. We have to remember, though, if the market, the broader market does break down, that it's likely to take the semiconductors with it. Financials had another week where, the financials were up 1.5% for this month so far. We lost a little bit of ground this week, and that was, we had seen the pattern on the 10-minute time frame, this pattern of higher highs and higher lows, which was just very consistent, broken on Thursday, and now we're seeing a little bit of a pullback. What we'd like to look for, what we'd like to see in here would be for about 1585 to hold. 1585 is where we saw some prior resistance that held as support. It's also right there at the 50-day moving average. You can see in the lower left corner is $15.84. So ideally, we'd like to see it maybe settle down in there because it is a stronger group, and the weekly time frame, we're still in an uptrend. We had seen a shakeout to the 40-week or 200-day moving average, and it's still set up positively. In fact, if you look at some people in the chat room, we're talking about Bank of America or Citibank and Bank of America still looking good here. So there's some strength in the banks overall. The gold, as we had mentioned, is still kind of really, we were talking about this inverted head and shoulders pattern and the potential that it was coming up the right side of that shoulder with the neckline rather, up near about 174, 175. But 3 weeks ago, we saw that gap down and the market has continued to be weak. So that was right here, that gap down that I'm talking about. And now we're into an area where we're just above the 150 and the 200-day moving average. That's the 30 and 40 week. So perhaps we continue to drift down towards there and then find some support. But right now, there's no reason to be buying into this level. As I'd mentioned, the U.S. dollar had a rough week. You can see the big red candle here on the weekly time frame. And this market has, it rallied about 5 weeks ago. It rallied up to the conjunction of that 200-day moving average in the prior support area in about 22.35, and it found resistance there. And now that the dollar continues lower, so it looks like it's at best maybe going to begin to neutralize on the daily time frame if we get down towards about 2160. But there's no reason to be involved there. So we're seeing a lot of movement in these markets. There were some great opportunities for long and short ideas this week. Those are something that we talk about every single day on Alpha Trends Premium site and in the chat room where we mention those. So if you're not familiar with it, I'd encourage you to take a 2-week free trial. And everybody have a good weekend. I'll talk to you next week. Thank you.